Greetings traders, this is Houston Trong from thetradingedge.org, and here is your weekly market outlook for March the 2nd to the 6th, 2020. So that was an interesting week to end February. Now, if that's not an understatement, I don't know what is. So unless you've been hiding under a rock this past week, you've probably heard about the historical precedents that were set this past trading week as the markets basically crumbled and corrected to the tune of over 10% on most of the indices. And while, if you recall from 2 weeks ago, I had posted a weekly market outlook video, and the title of that post was, if you recall, a correction on the horizon. So while the correction this week didn't surprise me, the speed in which it transpired caught me off guard and definitely caught many veteran traders off guard, because this type of decline is very, very rare, very unusual, and it has a lot of people scratching their heads about what could possibly be next. Because while we've had more significant declines in the past, so in terms of actual percentage losses, this is a big loss, but was not the largest of losses. Since the 30s, we have not seen the market crack like this from all-time highs at such a rapid pace. So usually, I'll put a link in my in the notes in the video here. But if you refer to a video I had made last year where I analyzed all of history's major market crashes, when you tend to have really big declines, so when there are steep corrections and crashes, they usually actually happen after a period of weakness. So to have a steep correction like this one out of the blue, especially as it comes right off after making all-time highs, it's very, very unusual. So this is why we have a lot of folks sort of asking the question, what is the market signaling? All right, what are we not pricing in or missing here that has forced the market to correct so severely? So lots to talk about in this week's video. I'm not going to spend a lot of time, talking about the historical precedents, because, you can find all that stuff on the internet. But we'll talk a bit about, how to manage yourselves in this current trading environment, in this current, market environment. We'll take a look at the this past week's charts, because they're very interesting to look at, and the more you look at them and feel for what it's like to trade the volatility of this past week, you'll be more prepared for the coming weeks. Because what we do know about volatility like this is that it tends to stay elevated for a persistent point in time. So it doesn't simply drop off right away. It does take some time for that fear to break down. Now, once the VIX does begin to sell, and once the fear begins to definitely lift, then you will see the VIX drop quickly, significantly. But this volatility that you've seen here now, this should stick with us for a little bit of time. So let's talk about that for a quick second as we're on the topic. How do you manage yourself and your trading in these types of volatile environments? So if it's your first time trading this type of environment, if you haven't had a chance to trade, if you're a new trader, or you never got a chance to trade the 2007, 2008 market crash, then this might be a new environment for you. Now, we did have that really nice correction back at the end of 2018, and that's probably the closest thing that has comes to this type of trading in the past couple of years. But if you weren't even around for that, here's a couple of small tips, right? So because the market volatility is so high, you need to make a couple of adjustments. So there's a very sort of popular market saying that goes something to the effect that volatility is a trader's best friend and a portfolio manager's worst nightmare. And the reason that is because when volatility increases, that means the ranges increase. So by definition, the ranges, the things in the size of the moves, so to speak, they increase. So if you take on even the same dollar risk, let's say you buy a $10,000 position, right? Well, now if the market had been moving previously, right, let's say 4 points a day, and now all of a sudden it's jumped up to 13, if you're still investing the same dollar amount, you're taking a lot more dollar or a lot more risk because of the actual size of the price movements. So knowing that when when volatility increases, the ranges increase, you have to begin to size your positions accordingly. So one of the biggest mistakes that traders make in these types of environments is that they are not focusing on their position sizing, and they're trying to keep things constant and not adjusting to the volatility. So I myself use a combination of price to size my trades, and I also sometimes use an ATR based stop method that factors in range. This is why my position sizing is variable based upon the volatility. But if you're simply buying $10,000 or $100,000 or $1,000 positions every single time, you can take very, very large losses as compared to simply, let's say, 20 days ago when the volatility was maybe 3 times less than it is currently. So to put it in perspective, let me give you some of the ranges, right? So right now, the SPY yesterday on Friday, the 28th, its range, so I'm not talking about the ATR, I'm talking about the daily range. That means from the high to the low. So yesterday's range was about $13.4. So from the high to the low, that was the range. So the 5-day moving average was 8.5. So just 5 days ago, that average was less than, it was 8.5. Now a 20-day average is 4.3. So you can just see, compared to the 20-day average, we're up over 3 times the average range on the S&P, on the SPY. On the Qs, if you're curious, yesterday's range was around 10. Okay, the 5-day average is 6.71, and the 20-day average is around 3.4. I can't read my handwriting. Around 3.42. So around that. So it's close to 3 times the levels of where I had been trading, based on that 20-period moving average. So you need to be positioning sizing yourself properly. Otherwise, you can really, really damage your accounts if you're not factoring in volatility. So that's the first thing. So making sure that if you're trading in this environment, that you're position sizing properly, right? So this is why it's trickier sometimes to trade things like futures, where if you're trading a small account, and you're trading a large contract, you can't get any smaller than trading one contract, right? So this is why sometimes this is why the micro futures are useful to some traders, because you can trade a smaller contract. But if you're trading a bigger contract, then you have no choice, right? Then you have no choice. You have to try to size down as best as you can, or try to pinpoint better entries for your trades. The second thing you can do, and that goes in line with this, is to also increase your time frames, right? So if you're used to looking at, let's say, the 5-minute chart for your trades, recognize that, as we just mentioned, the ranges on those 5-minute bars will be a lot larger than they were 2 weeks ago, all right, 20 days ago. So you need to count that as well, because what we're seeing now is that we're having moves on the hourly chart that used to take a whole day to accomplish, right? So you have to adjust that. So you can't be trying to take the same types of setups necessarily on the same time frames without recognizing that there's so much more range due to the volatility that's driven by that volume, the volume driven by fear and greed. Okay, so those are really two really important things to think about as we kind of launch into this video, is to adjust to the volatility by, number one, making sure your position sizing is proper. Otherwise, if you're trading too large of a position size, it's going to affect you psychologically. Your P&L swings will be too large, and you're not going to be able to hold through the moves, or you're going to get stopped out and take some bigger than expected losses. And secondly, by taking a higher time frame, you're adjusting to the actual new trading environment. That is, the ranges are a lot wider. You'll see when we talk about the charts in a few moments here that when things get this volatile, I move from simply looking at a 4-hour chart for the bigger picture, and I go down to the 60-minute chart, because there's so much. Because now, what used to take 4 hours is now taking 60 minutes, right? So this is why we drill down on some things to get some of these different perspectives. Okay, so let's talk about the charts now, and we'll launch into the week that was, and then we'll talk about some of the things to look out for the coming month, because this was significant, right? So this is how this is the last trading week of the month, February. The month is now finished, and now we're launching into March. And we have a very uncertain trading environment here now, but now we have some clear levels on what to look for. So before we get to that, let's talk about the econ calendar really quickly. This coming Monday, we got the ISM number at 10, oil number at 10:30 on Wednesday. Watch for that because oil has been destroyed. We'll take a look at that chart, or the energy chart, later on. Jobs claims on Thursday, and then Friday we have the unemployment situation. I think the majority of the headline risk will continue to be the coronavirus news. So the rapidity of the infections and how quickly it spreads across the globe, that's going to be I think first and foremost in terms of the news flow. We do still have earnings. There is less earnings now, but we do have some important names that are reporting that I think are worth watching. Monday we got Tilray JD for some high beta names. Tuesday Target, so we'll be watching for that. Wednesday Zoom has been holding it really well, so Zoom should be interesting to watch. ZM on Wednesday. Thursday we've got Costco, and then Friday pretty slow earnings day, so nothing too much to report on that day. So with that being said, always refer to your earnings calendar. Make sure you're not taking on any unnecessary risk. But let's get into the charts. So let's go to the VIX chart as we always do at this time, and let's begin from there. So let's begin from the high level, and then we'll jump to the lower time frames. So going into let's talk about February now. What do we have here? At one point, right? So we did not close on those highs, but VIX has gone up. Not at one point was up 91% from the lows of the month, from the lows of January. So from Jan's lows to Feb's highs, there had been a 91% move, right? So VIX nearly tripled in the span of 1 month. So what a move on VIX. And if you recall what I was saying last week, I had my doubts on if it could be done, and I said, well, if VIX, because what we were saying was that I was doubtful that we could break above this high here with only 1 week left. But the market certainly surprised me there, and that's the thing why we outline these levels, because as I said last week, if VIX does break above this monthly high, we want to know about that, right? Because that is a reversal on the monthly chart. So having that understanding is very useful, because we know that things happen in domino fashion. So we had marked the monthly high as a potential reversal level, and we also mapped the prior week's high as a potential reversal, because it happened last week already. We had said, we already got the reversal the week prior, right? So it went down and went up the prior week. We said that's your weekly reversal. The question now is, can it take out the monthly high? And as I said, I thought it was going to be a tough order, but if it did happen, you'd want to know about it. And that's what happened this week. So this week we had a big gap up, which basically cracked a bunch of levels, and then we proceeded to rocket higher. Now look at the brown information we drew, again, months back, right? You know how we've been drawing this brown information. It's been playing up very, very nicely. Again, this brown information had caught the lows of these prior all-time lows. We had broken below that. We came back above, and then we looks like we had broken convincingly to the downside. Now look at that move this past week, right back up there, but found resistance on that broadening formation resistance line. So that said prior had been support, now had turned a bit into resistance. Let's see what happens there. On the weekly chart, we are deeply into the Bollinger Bands. So now, if the VIX is to go higher, it needs to do the Bollinger Band walk. Okay, so that's what's being signaled on the VIX chart. Okay, so here's what we saw here on the Monday. So on the daily chart, what do we see? Just basically a bunch of gap fills, right? So here's where we closed off last Friday. We had drawn in our levels, right? So okay, there's the gap right there. If it breaks above that, we want to know about that. That gap immediately got filled with that gap up here, okay, on Monday. So that gap immediately got filled, and then it was gap hunting time. So at this point, Monday, they filled that gap right away. Then on Tuesday, they filled that gap right away. Now I'm going to delete these gap lines. On Wednesday, not Tuesday here again, yeah, we took out that gap there. Then Wednesday, inside day, right? So big acceleration move, impulse move, consolidation on Wednesday. People thought things were clear. Then yeah, they shocked them again by going Thursday, Friday to the upside. So inside bar up, simple pattern there. Inside bar up, up. Now here on Thursday, they gapped up again and then filled that gap there. Okay, so now we do have a few unfilled gaps here now on the VIX, so I'm going to move some of these gap lines. And finally on Friday, we filled this gap way back here from October the 10th, 2019, and that gap got filled. So you saw the same thing on the SPY with a bunch of unfilled gaps on the SPYs, the Qs, the Russells, and the Dow. These are all gaps that had, we talked about in the past that had created some of that unstable market structure that was at risk of being filled. And this is what happens when you have that weak market structure as a foundation for your rally. Eventually, if it comes in, those traders are gunning for those levels, and that's what we saw there. Again, with the surprise is how fast that happened, because this was a 90% move from the lows, right? The 90% move from VIX trading below here, right? Below $14 to one point here, trading close to hit 25 on the button there, right? So 25 right in the button. Friday we did come in now. We're trading well above the Bollinger Bands, right? So well into it. So now, if you're a VIX buyer, you do not want to see it break below this prior day's low, because then you can possibly come back in here again to backfill this, because we do have some unfilled gaps now on the downside. Let's move some of these gaps, and we have one right there. That on Monday, if we do see it come back in, then we possibly get that gap filled there. We have another one here now, right? And we have another one down here. Okay, so I'm just gonna go ahead and put in that last gap for us. We actually have more than that. We actually have one more below that as well. So I'll just draw that in very quickly, just to note that, and we'll carry that forward, right? So there's those unfilled gaps now to the downside. We still have some more to the upside as well. So the next one in play here, if it continues to rock it up, is 26.24. So that's the news flow. People are, the news flow, it's all news flow driven right now, right? And we're trading on news flow and technicals. So no one knows at this point how far this thing will go, to the downside for equities or to the upside on VIX. It's really based upon on fear and greed at this point. And if things start to trend to the downside, that means there's herding, right? And that means everyone's loading up on one side, and that means things can go a lot lower. At the same time, when the trade gets crowded, that sets up the potential for a pullback, and you obviously a bottoming process for equities, because fear can only remain elevated for so high when you're talking about the VIX product, right? So even when you go see a scary movie, you're not necessarily scared the entire movie, right? There are moments where you're very, very scared, perhaps even panicked, but it doesn't remain for very, very long periods of time. So expect at some point that VIX will give up some of these gains and pull back into the range. You just don't want to jump in front of that ship necessarily and get run over. So that for now is the VIX chart, and so there's some very clear levels to be watching for to the upside and to the downside. Okay, so now let's talk about the 2-day chart, and this is one thing we'll be watching for to see if the momentum continues or not, is this sequence here. So here it ignited. If you recall, last week we were ending the former trading week with a outside bar and up. Okay, so the question was, how far was this outside bar and up going to go? And we were not going to step in front of this or short this thing until the momentum got extinguished. And that's smart, because look what happened. Outside bar up, up, up. Momentum all the way, right? And until you see a prior low get extinguished, and this is a pattern we talk about all the time, and we're going to see it because it played out in reverse on some of the equities markets, not only on the daily time frame charts, but on the larger monthly charts. This is significant. You want to be waiting for and watching to see how momentum gets extinguished now on this VIX chart, right? So the 2-day chart, up, up, up. You do not want to necessarily be trying to load the boat up on shorts here until you see this or prior low get taken out. That means momentum has been temporarily extinguished. Not to mention, we're deep in the Bollinger Bands too, so this will definitely cause a pullback. I'm not saying it's going to fall back to all-time lows again, but certainly you might see a bit of a dead cat bounce on the equities markets if it breaks back down here again and gets back into some of these gap fill levels. So on the short time frame chart, is what you want to be looking for is right there. Okay, so there on the final trading hour of Friday, we had a big outside bar. So probably shorts covering, because had you gotten long earlier in the week, you don't necessarily want to hold this trade over the weekend and perhaps wake up on Monday, or start your Monday, and you have the markets gapping up, and then all of a sudden this VIX trade, you give back a lot of money. Because if we know anything about historical precedents, when we know that the governments and the Fed have no problem stepping in and accommodating the markets. So if they think that the markets are looking shaky, there will be monetary policies put in place. There'll be interventions put in place to try to buckle things up. So being short is not always the safest place to be. So nothing wrong with, especially if you caught this move, to take a bit off. I'm sure a lot of traders did that, and we had that short covering to close off the Friday. So if you just take a look at the charts, you really want to be focusing on when you have a week like this and you have volatility this high, the hourly bars tell the whole story, right? They tell a very clear story. If you can read the hourly, if you can read price action, who's in control. And this week it was cleanly and plainly that the buyers were in control, because every single pullback was a buying opportunity. If you know one of my favorite patterns, the inside bar reversal, you can just eyeball it and you can see it that it worked every single time this week. So here, inside bar down, right? Inside bar down. That means people try to short this. They went inside bar down. Unfortunately for them, you're above the monthly open, you're above the weekly open, and then it breaks to the downside, pops back up, and then it goes inside bar. Sorry, it breaks above that breakout bar, and then it's called an inside bar reversal back to the upside again, taking out that pivot high and launching higher. Here's another one to end the this is the 25th. So inside bar down, inside bar, once this thing breaks up, is your inside bar reversal back to the upside. Inside bar down, they try to short it again, right? Didn't work. They get stopped out as soon as it breaks above there. In fact, it gaps against them. Inside bar down, right? The shorts tried again. They keep trying to break these inside bars to the downside. It fails every single time because the buyers keep stepping up. Inside bar reversed, back up, taking out these guys' pivots, and back up. Inside bar down, right? Reversal right there. Boom, take out that high. Okay, so it is you can very plainly see the buyers were in control there. And the 60-minute chart, when it's this volatile, is the time frame you want to be looking at to see who's in control during the intraday session. Because if you're looking at, let's say, a 10-minute chart or something too low of a time frame, it's choppy and it's messy, right? It's just tricky stuff to trade because, number one, the ranges are really wide, and if you're not used to them yet, it takes a bit of time, especially if you've been trading a pretty low volatility environment, which we had again at the end of Jan here. February is very tight trading. And all of a sudden now you have these bigger swings. It's not entirely clear. Look, you have a bunch of outside bars. It's tricky trading, right? So if you get even, some people trade a 5 or 2 minute chart. That stuff is very tricky and choppy because that's the nature of volatility. As people are getting scared and fear and shaken out of trades, you're gonna see price move quite aggressively. Clean that up by jumping up to the 60-minute. Okay. Again, we used to look at the 4-hour, but now the 4-hour isn't giving us that much. So we want to, because it's such a large range now, we want to zoom back down a bit to the 60 to get, again, a really clear perspective of who's controlling the intraday. Let's jump to the SPY now. Let's talk about that. So the SPY, as we have here, okay, to begin, let's talk about the start here. So from peak. Right, so the peak of February to the low of February was a minus 15.79% move. We did not close there. We only closed down minus 12.63% from the recent highs. But at one point we had been down close to 16%. Right, so that's getting very close to bear market territory. Bear market as defined by having a correction that is steeper than 20%. And it got close there. It got close. So on the 3-month chart, let's take a look there. Let's start from the high level. Okay, so I'm going to delete this line. We don't need it right now. So right now, the SPY has not done a reversal yet on the quarterly chart. If it breaks below that low right there, okay, that's going to be significant because it's more rare than seeing the monthly or the weekly charts get reversed on. So we want to be watching that level because it's getting close. So let's put that one in purple there. Actually, let's put that one in blue. I'm sorry. Orange, I mean. Okay, so we want to be looking at that level here the quarterly low to see if that guy gets taken out. It came down to 284.82. It got as low as 285.54. So watching for that with 31 days remaining in Q1. Okay, so on the monthly chart, see what happened here? So this was the question, right? The question was always, this is a momentum up move. We talked about it just when we talked about the VIX chart on the 2-day chart. But here's your outside bar up move. I call it Momo up. This is a momentum pattern that starts when this impulse begins. So when you have this large outside bar and all of a sudden it goes outside bar up, that's momentum because people have to chase that. Outside bar up. So 3 aggressive months, and had been 4, right, going into February, of continuous momentum to the upside. The question was, how and when was it going to extinguish? It happened this month, right? So that was what happened, and this is what happens here. Once momentum gets extinguished, this is what could happen. It comes back in the range and back out the other side. So this is a very high likelihood now that October's lows for the SPY will eventually get taken out, because as we'll talk about, you'll see in these charts, outside bars, and I've said in many videos, outside bars are a terrible place to put your stops. So if you're placing your stops at the highs or lows of outside bars, those are terrible pivots, right? Because if you don't know, and if you haven't heard me talk about, outside bars are basically broadening formations. Okay, so that means you have a higher high and a lower low, if you look at it from a fractal perspective, right? So you'll see in a few moments here, but from a fractal perspective, they are broadening formations, outside bars are broadening formations, and that means because they're broadening, you can expect the pivots high and low to get taken out at some point if it comes back in the range. If it comes back in the range, you can expect it to probably come out the other side. Okay, so that's the analysis on the monthly. Here now we got March coming up, right, on Monday. So what's the next bar? That's always a question with the outside bars, is what is the next bar? Because one bar in itself is not significant. We want to know what's the next bar, and is it stay inside or outside the previous bar's range? Because recall, right, let's go back here. Yeah, right here. So here, this was an outside bar right there, and it went outside bar down. So that looked weak, right? Looked shaky at that point, because you had been trading. This is back in June. You had been trading with full time frame alignment to the downside. Okay, again, when this happened down here, you're below the quarterly open, but it popped back up in the range again. And as soon as it got back in the range, there's a possibility it comes out the other side. Okay, not saying it's going to happen this time around, but saying that's always a possibility with outside bars. This is why, as I just said, it's not a good place to put your stops, because it comes back through, you know you're coming at the side, because that creates the broadening formation, right? You can see a higher high, this high is higher than that high, a lower low, this low is lower than that low. Okay, so this is something. This is a possibility. One possibility of the outside bar is it breaks down as the next bar comes down, comes back up again right through it, creating a second outside bar. That's a rare sequence. You don't see this very often. It does happen though. More than likely, more often, you'll see an outside bar and up or down scenario. So like what happened here in October 2019, we had an outside bar. We had broken below the prior month's low. Looked a bit shaky there as well. Bars bought it right back, and then we had that scenario. Okay, so one outside bar up. So now going into March, do we see an outside bar down situation? That would be a momentum pattern, right? If it goes outside bar down, this will not be extinguished until the prior high gets taken out. So whatever March's or April's high, if it breaks below, March's high, if it breaks below Feb's lows, then you need to see the high get taken out in order for that momentum to get extinguished. All right, so this again is one of the possibilities for now for the coming month, as we are coming back through the range, right? So we broke above this broadening formations, highs. We're coming back to the range again. This puts these pivots in play. Okay, so let's talk about the weekly chart. The weekly chart here now. So on the SPY, we had the reversal, right? So we were watching last week. We had said, okay, the VIX already did the reversal. What's going to happen on the SPY? Because if you break below this week's low, right, you're going to get a reversal on the weekly chart. It happened on Monday because it gapped down, right? So it went up, down, there's your reversal, and it comes right back to the range. It did come right back out through the other side, right? So it took out the other side's range, took it all the way through there, and it did break below the Bollinger Band lows. However, it did pop up. So that's, you're not doing the Bollinger Band walk here now, but you do want to see, is this the dead cat bounce, or does it continue to roll over? On the lower time frame charts, it gives you a bit of a more clear picture. So here on the daily, let's do the 2-day chart first. You got the same thing as we do on the VIX chart, but in opposite, right? So there's your outside bar, down, down, down. We need to see a high get taken out prior high to get taken out before we see that momentum extinguished. Because on the daily chart, it looked a lot like the VIX, but in reverse, and that means they were just filling gaps, right? So we had all these gaps to the downside that needed to be filled, and it did it this past week. So we had a gap there, right? And that's now gone. So let's go ahead and draw these new gaps in. We had a gap here that got taken out. So let's move our new gap. It's right there now. We had another gap right there that got filled. We had a gap here that got filled on Thursday, so we can now close this one. And now that gap there did get filled on Friday. So you can see here now, so I'm gonna delete this one. That one got filled as well. Actually, I believe there's one more gap down here that finally got filled. Right there, right? Yes. So right here, there was a gap right there at 288.53, and it got filled on Friday. So that's what happened. So here now, this gap actually did get closed, so I'm going to delete this one because that did get closed. And same with this gap here, it did get closed as well. So intra-session, we did have gap fills here on Thursday, Friday, which was tricky, because on Thursday, what really caused traders, I think, what led to the sort of the collapse on Thursday afternoon and that gap down on Friday was that we had a number of buyers try to, look like we had bottomed in the morning session on Thursday. I myself had taken on some trades and took home a couple overnights on Thursday because it looked like we had bottomed on Thursday morning until the it closed near the lows, right? So it fills the gap, and then for the rest of the session, if you recall, if you didn't trade Thursday, then it looked like this. So I'll show you the hourly chart because it was very nice. So here's Thursday, right here. Right, so it goes outside bar up, up, and it fills this gap here from the prior day, and then it proceeds to roll over because there's the exact same pattern again, right? Outside bar up, up, that's momentum, and then as soon as it broke below that low at 12:30, it came right back through the range again. This in the bigger time frame, right, just on a bigger perspective, that's just the bounce to be sold, and that's what happened on Thursday. So I think a lot of traders capitulated here. I myself, I had bought some Apple, some Roku, and some work to try to carry as a swing long. When this thing rolled over, I got out of my Apple because once it broke below there, so I do not want to be carrying Apple overnight because that is that was a riskier setup. Whereas the work and Roku trades, they were already deeply oversold, and I'm not going to have time to talk about those trades today. But surprisingly, when the markets gapped down, they did not stop me out. They held their prior day's lows, and that was my stop, and I'm still in those trades. But SPY gap down here again, the gap fills, and the difference between this day and this day is the following. So they tried to do the same thing, the same sort of play on Friday, but it didn't work out for them. Why is that? Well, there's a slight difference, right? So here, when it goes outside bar up, up, once it breaks below there, and it comes back through, if you breaks below there, it's going to come after that pivot right there, right? Because that's your failed momentum to the upside. Once it breaks below this green line, that's your daily open, okay? The daily open is what, when you look at that, that's what tells you whether the day is green or not. So as soon as you breaks below that green line, that is now a red bar on the daily chart. And that just gives one more time frame participant the choice to actually short, because now nothing looks good, right? If the daily looks bad, the weekly chart looks bad, the monthly chart looks bad, the quarterly chart looks bad, yeah, you're probably going to be shorting, correct? So that point there, that was the final line in the sand. When it came back through that range again, yeah, we found a bunch of sellers, found a whole attracted all the sellers. They tried to do the same thing again on Friday, but it was slightly different. What was this time? Goes inside bar up, inside bar reversal. There's your inside bar reversal, breaks below there, and it takes out that pivot as it's supposed to, because that's the next pivot. But this pivot's above the daily open, and you can see right there the buyers defended that green line right into the close. So it looked like it was close, right? So for 3 hours, from the 130 bar to the 230 bar to the 330 bar, they were touching the daily open. So the daily open was, the daily bar is literally, turning red green, every several minutes, as there was a big battle right there on the daily open. And finally, with 1 hour left, maybe a little less than that, the buyers decidedly won that game, as I believe, as I said before, that the shorts simply decided to cover the shorts going into the weekend and not risking giving back too much. Once you get some short covering, then anyone who's a late short has to cover as well, or they'll get underwater. And we got that nice push, if you're a buyer that is, into the close for a big 2.5% move to close off Friday's session, close off the final trading hour of the day. So big hour for the buyers, that final hour of the trading day. But that's the understanding there, right? So on the 60-minute chart, you now have that hourly outside bar to the upside, right? It's an upside bar that's green, outside bar that's green. Question is, again, what's the next bar? So let's talk about this really quickly now, and then I'll quickly get to some rest of the charts. So if you recall, I had made that video 2 weeks ago about why a correction was imminent on the indices, and one of the reasons for that was this chart. And this chart, if you don't remember what it is the SPY in the candlesticks, and we have the blue line is the S&P 100 stocks. So the number of S&P 100 stocks currently trading above their 50-period moving average. So when we had this move to the upside here, I had mentioned, right, this is a serious issue. We had poor market structure, and we had now a negative divergence in terms of the underlying breadth, right? So you had higher highs being created by price, but less and less stocks actually trading above their 50-day moving average. And if you do the work, you'll see that this is significant. And the question was, how long can it sustain that? And this past week, we got our answer. So now, right, going to this week, this is the rapidity in which, if that's a real word, the rapidity in which things change. So at this point here, we had about 72% of stocks. This is 2 weeks ago. We had 72% of S&P 100 stocks above the 50-day. On Friday, you know what that number is now? 4%. So it came down to 4%. So now we only have 4% of S&P 100 stocks currently trading above the 50-day. That's how steep of a sell-off we had and how fast that was. Okay, so you have to really go back a ways. And this is why I say it, the last time we had this level of, if you want to say it, extreme action, I'm not going to call it oversold because things can remain oversold for a long period of time, but these extremes is way back in here. 2018, that Q4, the infamous Q4 of 2018, when things got as low as, look at this, that's like 1%. So at one point here, we had like 1% of stocks above their 50-day, and back in January was around 1% as well. So you're getting to those levels now where historically you've seen some bounces because of just the extreme nature of how oversold it is. Now most people are at this point expecting a bounce. Question is how far will it bounce, and we'll talk about that further in a little bit. But no one really knows. You need to simply, as I always do this in these videos, and what I try to espouse is the best you can do most of the time is to simply respond to price, because no one really knows where things are going to go. So here, when we bounced back in 2018, we had a fairly innocuous bounce. So it started off as a simple, looked like to be a standard, looked like sort of a V bottom. It actually stuck. So most people are expecting the double bottom, for double bottom or something to that effect. Again, there are a lot of bottoms and they're created differently, but you need to line things up by looking at different time frames to see the bottoming process. That's how you see bottoms being created and tops being created, as we showed already with the quarterly and the monthly and the weekly charts. Again, I refer you to the video I created on the work that I did for analyzing some of the biggest market crashes in history. That I think will be quite useful if you haven't done some of the work yourself. All right, so now we're getting to an area where it's very of extreme, so you can definitely expect a bounce. If you go back to the SPY chart now, this is kind of what you want to be looking for. So that's the 60 chart. The daily now, if we bounce, and all indications that people are looking for a bounce, is that you want to see how, if we're just doing trend following stuff, you want to see if it can come back to the 8 period moving average. If you can get above the 8 and then close above the 8, then you have the opportunity for things to move a bit higher here. But if you cannot touch the 8, or cannot even close, if you can't touch it, if you cannot close above it, then the trend remains lower in the short term. Okay, so that's a very simple simple way of looking at it. But right now, because things are trending, you're responding to price in a trending fashion. Okay, so that's the trending methodology that you could be using. Okay, so let's now fast forward a bit. Now let's go a little faster. Let's talk about the next index. That's the Qs. So Qs did the same thing as the SPY. It was down close to 16.55%. Now only down 13.3 from those all-time highs. Significant though is this, just like the SPY, it had been going outside bar, up. Now it comes right back to the range again. Look at that, sitting right on this broadening formation resistance line, right? So, or support line. Had been resistance, broke above, come back, turns into support. Okay, but basically testing the initial breakout, right? So that's what you see often, is this breakout level. It's going to come back and test it. If it keeps going, it's going to come out the other side. October's lows, if it comes back into the range here, is what you can expect to happen if the selling continues. We might see a bit of a bounce to the upside, but if selling continues, that's the next pivot you want to be gunning for. So on the 3-month chart, looks like this. Has not done a reversal yet on the quarterly, because that would be significant. The Qs was and still is the strongest of all the indices. It has not reversed yet, right? That means it hasn't taken out Q4's lows from 2019. If that happens, that would be very significant, and you want to be aware of that. Okay, so there's your quarterly, there's your monthly chart, your weekly chart. Reversal happened there, right? So up, down, reversal. So in order to be a reversal to the upside again, and this would be it's very low probability, but anything's possible. Some of these are less probable than others, but anything's possible. In order for price to actually create a reversal on the weekly signal, you actually have to break above this week's highs, and that's a tall order because that's really far away. Because, right, you closed here on Friday, you need to have a 9% move roughly, right, to break above this past week's highs. Is it possible? Yeah, something happens, and let's say the Fed, or maybe they find a global cure in the next 24, 48 hours for the coronavirus. They maybe get that kind of upside move. But that's what price would needs to do for there to be a weekly reversal. So more than likely though, that's not going to happen because that's a very big range. More than likely, what's going to happen is that we're going to either have another down bar or a bar that's going to be inside bar, right? And then if it's going to be a reversal, then that bar's high has to be taken out. That bar's high will be lower. It'll be in here somewhere versus all the way up here. So if there's going to be a bullish reversal, that's what you want to be looking for. Okay, that's what I mean by responding to price, by having understanding of how price reverses and then being prepared for that, versus trying to guess and pick bottoms. Because at this point, you cannot know. No one knows. If people can tell you, if people are telling you they know, then unfortunately it's one of those situations where, once again, they're either ignorant or they're lying. So let's talk about the 2-day chart. Same pattern as the other ones. Outside bar, down, waiting for the momentum to get extinguished on the 2-day. Okay, and as we said on the prior chart already, right, on the daily chart, this thing found support right off of this broadening formations trend line. Okay, so Friday came all the way down in here, all right, and we had that gap filled right there. So there's a gap right here at the 198.87 level, right? So that gap was filled, and then it bounced off of this Brownian formation's trend line, and there's your 200-day moving average. So both those areas held. Buyers stepped up, defended it now. Let's see what the new month brings us, because we know already it's an outside bar, right? So what's the next bar with the Qs? Like we said with the SPY, is it to the downside, inside, or something else? Let's talk Dow. So Dow actually looking a lot similar to the Qs and SPYs, but actually a little bit uglier, because here on the 3-month chart, look at this. That's significant. So this is very significant now, because on the quarterly chart you have an outside bar. It took out Q1's lows. That means it took out October's lows. So back here, if you recall, this is Q1 2019. We had that inside quarter. It was very tight trading, right? It was very, very tight trading. We got that breakout. When it went outside, inside, boom to the upside, right? That's a breakout. It kept going. And this is what happens when breakouts fail. Right back to the range. And who bought that breakout? They're at risk. They got stopped out here, or it's come back against them. If they haven't moved their stop, it's coming back against them, and they're underwater on that trade now. Anyone who took that trade a year ago, right? So had you bought the Dow a year ago, Jan, 2019, you bought anywhere in this area, you're now underwater. Okay, so that's basically a year's worth of work gone in basically a week. So pretty significant there. On the monthly chart, you got that outside bar. Okay, so of course the quarterly still has 31 days left, so this bar's not finished yet. Could still close anywhere. We don't know what this bar is going to look like yet for another 31 days. The monthly chart, the month is done. Question now is, how far back into this Brownian formation do you get into, right? Because there's October's lows right there. That's the same area that we're looking for the Qs and SPYs, right? Can we break below October's lows? Because it did it for the Dow already. Here's the next pivot right there. Actually, I think it took it out already. Yeah. 247.04? Yeah, 247. Right, so that's why you never put your stops below outside bars, because that one there got taken out. So that's out. And now, how far can it come back through the range here? Because the Brownian formation goes up all the way to the other side. On the weekly chart, you're deep in the Bollinger Bands on the weekly chart. So now it has to keep doing this Bollinger Band walk to the downside. Otherwise, it's going to pop up. Okay, so that's what you're going to watch for that. On the 60-minute, so same picture as the other ones. Watch for that outside bar. How far does it take us? Outside bar up, in, or down? Okay, and that's what you want to be watching for in the very, very short term. Let's talk Russell now. We'll speed up a bit here. For Russell had already been the laggard of the indices, and now on the monthly chart, it's taken out Q4's lows from 2018. Outside bar on the quarterly chart, significant now. Lots of quarter left, but you do want to know about that we're trading outside bar there. Okay, monthly chart. Oh, sorry, that's a minute chart. It doesn't help us. Monthly chart, not outside bar, but a reversal bar. Here we drew it very cleanly the last few months, right? Or last few weeks. You do not want to see the Russell if you're a buyer break below Jan's lows, right? Because you're going you're trading inside a Brownian formation like this, and you're not breaking above that trend line. Now you break below that low, you're coming out the other side. That's what's happening now, right? So that low there, 157.34, it took it out. 143.91. Sorry, 144.93, 143.91. So that low is definitely lower than that low. And now you're at risk of taking this low here. I think it did it already. 144.25. Yeah, so that did it already, right? So this low is lower than that low. So technically, you could even draw it like that. But we're going to leave it like that because it can still go lower. So let's keep it as is for now. And on the weekly chart, what did we say here? All right, watch for the reversal. We're saying watch for the reversal because you break below that low, the prior week's lows, you're trading below the quarterly open, right? And then look what happened on Monday. It gaps down, immediately begins to trade below the monthly open. Full time frame alignment, folks, to the downside. There is no time frame that looks good, right? We saw the quarterly, we saw the monthly. The weekly is red. So all the time frames are pointing down. The dailies are going down. So yeah, they really took it to the Russell buyers now. And now we see on the bigger time frame charts that Brownian formation is playing out, and it came out the other side. It already did that. You can probably go down lower. It just came out the other side and took out all these prior pivots. This is what we always mean by, right? This low is lower than that low. That high, although this high here is higher than these highs. right? So you can even draw this a bit higher if you want. But that's why this is a outside bar. The highs are higher than the prior highs. The lows are lower than the prior lows. That's why we say that outside bars are basically correct broadening formations in a fractal form. So let's talk about TSX. Did the Canadian stock market, did it get any, did it find any safety? Actually, before we get to that, I'll show one final chart on the Russell here, because the Russell was trading very aggressively to the downside. It hasn't finished trading aggressively to the downside yet. Here, starting on, here's your Monday, Tuesday, Wednesday. On Wednesday, it picked up momentum. Outside bar, people bought this thing here thinking it was going to go in to the upside, flushed them. Outside bar down, 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 down. There is no higher high, right? So even on Friday, we don't have a higher high yet on the Russell. So you definitely want to see, can you get a higher high here, and that will extinguish that momentum to the downside on the 4-hour chart. It does have that outside bar on the 60, so that's working in the favor of the buyers. But you do want to see this 4-hour high here get taken out for at least that time frame to the momentum to get extinguished for the 4-hour. Okay, TSX. So was there any refuge in the TSX? No, there wasn't. So the Canadian stock market has its own glitches, literally technical glitches, I believe, on Thursday when the exchange was actually down for a while. So yeah, it was not the TSX's I guess best moments, and yeah, the charts reflect that. So here now, it was a slow grind up, right? 1, 2, 3 quarters, slow grind up, quick grind down, right? So as I said the last week's video, markets take the stairs on the way up and the elevator on the way down, right? Boom. So took out all these lows, right? So that low there, 15,960. This is lower, 15,896. Took out anyone who got long. So if you bought anywhere in the past 4 quarters, so back to, you know, this is Q2 2019. You're now underwater, or had been underwater until it popped back up on Friday. Outside bar there on the 3-month chart. So that tells you it's going to be an outside bar in the monthly, right? So boom, rips all the way through that sequence. And the weekly did the reversal, right? We had painted in. This is what's dangerous when you're trading like this, going right into highs. This is what I always say, right? The charts always look great before they look terrible, right? So that looks very innocuous if you don't know what you're looking at, because you're thinking, well, it's just going on all-time highs. Doesn't look great. Not necessarily, because that bar changes everything. Correct. This is why we want to be knowing about these wider time frames and when things are reversing on these higher time frames. So that happened this week to the tune of minus 8.86%. So no safety in the Canadian stocks, and there's still that Momo condition to the downside on TSX names. So let's go to the 4-hour chart. And it's pretty aggressive. So it actually started the week prior. Look, here's the Friday. Prior Friday, outside bar down, 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 down. Not one higher high, okay? Not one higher high the whole week. So they were selling it very aggressively. A bit of a bounce here on Friday, right? Because it went down. This is a potentially inside bar now. Reversal. Inside bar down. Breaks above this high. Gives you inside bar reversal to the upside. How far? We have to wait and see. But that would extinguish this momentum, because on the way down, there's no point like trying to buy this if you're looking at this chart, because you're not breaking any prior highs. So every single bar is met with selling, and yeah, you get run over because you buy there thinking, okay, well that's it for the selling, until you get a gap down and you get stopped out, right? So there's your TSX. Let's talk about emerging markets now, because that has been a great index to watch, and very much has been a canary in the coal mine. So EM so far, a lot like the other charts, right? So very, very red quarters, red months. Right now, put in an outside bar on that 3-month chart now on EM, trading inside this tight broadening formation. Monthly chart looks like this: 2 outside bars in a row. We were asking, you know, I said that in several weeks ago, a few times in the last few videos. How are we going to resolve this outside pattern? Because the outside, when you have these 2 sequences, you can usually expect to have something quite, there should be quite a bit of a move that comes out of a movement like this, because every time you have this type of sequence, people are getting stopped out on both sides of the range. So when one side finally gets it right and takes control, if these folks want to participate, the guys who are buying, and they have to take control. If they want to get involved in the trade, they have to chase. They have to cover, and they have to get short. So this is what's happened here now. Remember, we had been trading inside month for a while with EM. It took a while for this to happen. We've been trading outside, inside for most of the month, and finally now it resolved to the downside, taking out all these pivots. Okay, so there's your outside bar to the downside. Don't forget, last week we said it, right? It had done an inside bar reversal to the short side last week because it went inside bar up right here to the downside. It broke below the prior week's low. That was our red flag we talked about last week. The hard thing was getting in that trade because it gapped down against you. Unless you were already short, it was very hard to get in there unless you were down, unless you're trading intraday. So there was the reversal pattern there. Inside bar reversal to the downside on the weekly bar. Okay, on the daily bar, daily time frame, very nice stuff. I'm going to delete some of these gaps now because they did get filled. Okay, so that got filled. Okay, and these all got filled. You can see there had been a bunch of gaps to the downside, and this week we really filled them. Friday was a very nice close though for the buyers. They basically turned that really red day into basically a flat day. But look at that final gap down here, right there, way down at 39.44. Came all the way down, filled that gap, and they began to buy it back. So you definitely want to be tracking the gaps on your charts. So on Monday is what happened, right? So we gap down. On Monday, leaves the day green. People are quite, positive about that result. Outside day on Tuesday. Inside, there's a favorite pattern. Outside, inside, resolves to the downside. So outside, inside breaks to the down. On a Friday, they buy it back. Okay. So on the 4-hour chart, there's your let's get here. Okay, inside bar reversal. So there, inside bar down. Friday afternoon breaks above there. There's your inside bar reversal on the 4-hour chart. Let's talk bonds, and then we only have two more things to talk about: bonds and our gold products. But bonds going into highs, so people are now, driving or putting their money into government U.S. Treasury bonds as well as U.S. dollars. That's the safe trade right now. Surprisingly, not gold, and we'll talk about that in the next chart. But bonds, can we say inside bar up on the quarterly chart, right? So going into all-time highs here. The only issue here now is you're tapping the top of this broad information. So you want to see how it reacts to that. Can it stay above there or does it come back in? Okay? Because anytime you have an inside bar that goes up, there's the potential for it to come back out the other side in a subsequent bar. If something can happen and this ends up being the top and next quarter comes back down and breaks below there, that's a reversal. Inside bar reversal to the downside, back through here again. But you have a lot of quarter left, so that's not a scenario we're even entertaining yet. So 1 month chart, inside bar reversal to the long side. We talked about it already, right? 2-3 weeks ago. Inside bar down, pops back to the upside, breaks above that high, and it's off to the races, into all-time highs, but into that broad information, right? Monthly chart, into the Bollinger Band highs. Has to keep going with this new month. Okay, simple trading this week basically is continuation. Inside week, up and up. It's continuation, right? That's the move for TLT. Not big returns, but for bonds, very good. Close to 5% week for TLT there. All right, so bonds usually coincides with or correlates with the move to gold, because with this type of headline risk, you would think that gold would be doing amazing. But that's been sort of the second story is, people are scratching their heads on and trying to figure out, well, why did gold come in so much this past week? Because the gold and the gold miners, they were crushed. So going into this week, though, the gold miners look really good. So here, right, so we still have on the quarterly chart, right, 3-month chart, outside bar up, inside bar up. So this is a Momo condition to the upside on the quarterly chart. So even though it's come back quite a bit, it's given back 150% of the gains we had in Q1. You're still momoing up on that quarterly chart now. Question is, if you break below this, Q4's lows for the quarterly chart on MGC, the gold futures, you can come back into the range like we've seen already with the indices. The 1 month, you haven't done a reversal yet on the monthly charts. So even though it has looked quite shaky, you're still have not created a monthly reversal signal. But now we're trading to the downside, minus 1.34%. Okay, here's the weekly chart. So 2 weeks ago, had you bought gold here, right? You bought that break outside inside. You recall that trade I showed 2 weeks ago. That was a really good trade. You looked pretty smart, right? Until it came back through the range again, taking out anyone who bought that breakout, right? So I myself had missed that breakout. Unfortunately, that would have been an excellent trade, and I shared that 2 weeks ago. But it worked even more in the early part of the week, and then it came right back to the range, testing all the folks who bought that breakout. Came out right back out the other side, right? So here's your low, 1564.80, and the low here is 1563.4. So enough to take out anyone who put their stop below that pivot. Okay. Same thing. We have an outside bar now. What's the next bar, right? We're working bar for bar and trying to understand what's the next bar. Okay. So on the 2-day chart, this is was significant. Monday, it gaps up slightly and just guns it. So this was a really, really big day for gold here. At one point it was up, I think it was up over 3% or close to it. And then what happens here on Tuesday? It does a reversal. It actually does a reversal on the daily chart. And so here's the issue. This is the Bollinger Band walk. So I've talked about it dozens of times. So here's your Bollinger Band walk. If you break below this level, right, this low, you're going to break outside that Bollinger Band. This is what happens. When you break below the Bollinger Band, you're going to come back out again. Doesn't mean it's going to necessarily come right back and crash on you like it did with gold, but that's always the risk. That's what happened this week. You know, a lot of people are saying maybe it's because certain hedge funds were too loaded up on gold, and they had, you know, margin calls, or they had to free up margin for other trades that were not going for them, so they had to liquidate what was working. So in either case, gold, you know, that was one of the hardest hit areas. It was down to the tune of 4.6% on the futures contract on Friday. So there's a reversal. Right, so once you broke below there, it turned into a red week. That's the issue. When you open up high, you come back in, that immediately creates a red week, and that allows some time frame participants, the weekly guys, to perceive the week as being red, right? And so that's what happened. You're trading most of the week below the weekly open, so it gives them an excuse to short, right? Because the weekly doesn't look good; it's red, right? So even earlier in the week, it looked like a shooting star. So you know, it's you can't see it now because it's an outside bar. But imagine you didn't have this big long body down here. It would look like just like a small shooting star here. No one knew it was going to come back out the other side in one single bar to create that outside bar. Okay, that was always the possibility, but no one knew that was going to happen. So there you go. There's your gold move, and if you know, here's a very simple trade, and I'll share with you. It's one that I did not take, but I like to set up a lot. So right here, so right there, that blue line is the prior week's low. Sorry, is the prior day's low right here. So this is right here. Yeah. So there is Thursday's low. Okay, so here it goes inside, it goes here, reversal, there's a reversal here, pops back up again to close Thursday back at the range. So now if you break below this bar's low, they're going to come after that pivot right there. You may not want to take that trade on the daily chart, because this is with time frame, like, you know, you're sitting below the weekly open. We talked about that already, why that's perceived as negative by the weekly time frame participants, but you're trading above the monthly open, so there's a bit of time frame conflict there, and you're above the quarterly open right there. But if you do want to take a trade, right, to see how that plays out on the 4-hour chart, there was a really good setup right here. So this is the type of trading that I like to do, where here this is your Thursday. Okay, this is the final bar of Thursday session. Okay, during the market. This is the aftermarket. So here it closes right there. That's your low. That's your Thursday low right there. That's that blue line. So imagine, right, you see the daily chart. That's the blue line. Here it opens in the aftermarket. Okay, it pops up. If it breaks below that pivot low, then it's going to take that low out. If it takes out that low, it creates a reversal on the daily chart. And so very, very tight trade. Stop right there. Entry below the low, this low here, expecting this to trigger the reversal on the daily. In this case, it worked out very well. That's a plus 8-hour trade on that 4-hour setup alone. right? So that's the type of sequence you can look for when you understand the reversal patterns that are happening on the daily and the weekly on the daily signal. The week had not reversed yet. Reversal didn't happen until down here, way down here. All right, so that area there was 1581. So it didn't reverse the weekly until it came down through here, creating that outside bar. But here, right, the reason that's compelling is because you're below the weekly, and you know the ranges are it had done a Bollinger Band walk and failed. There's a chance it can come back in here again. You know, the aim was maybe to take out the monthly open. That was just, you know, because of the magnified volatility. You know, you end up getting a plus 8R move, but just to the monthly open would have been a good plus 4R trade, because of, you know, everything is sort of hitting the kitchen sink, everything is kind of being thrown out. You got down to as low as plus 8R. So very nice trade there on the 4-hour time frame. Okay, so there's your MGC. So one final instrument to talk about today, that's Bitcoin, BTC, USD. Let's look at the one on Bitphoenix. What did it do? A nice bit of selling on that one as well. Caught that trade. So on the 3-month chart, it did do an inside bar reversal. So really quickly here, how's digital gold holding up on its value? Gold is not doing a good job. Bitcoin, it's kind of just hanging in there. I don't think I'd be comfortable calling this thing having a true store of value yet, but it's certainly a really good trading vehicle. Right now, inside bar down on the quarterly chart, it did pop back up, break above the prior quarter's high, but back to trading inside the range there. Okay, so not an active signal right now, but something you want to know about. Okay, on the monthly chart, red. Okay, so it broke above the prior quarter's high, but now red, creating red month. Okay, so what's interesting is this. So that prior quarter's high, that red line there. See that red line? It's from this high here, that pivot is an outside bar. All right, this is why you don't put your stops above outside bars if I need to repeat it again. So outside, inside, way back in October 2019 to the downside. Anyone who got short that sequence, put their stops anywhere in the sequence here, got stopped out on that move there. And now it's come back in. We talked about the reversal that happened 2 weeks ago, right? So, you know, this is 1 week, 2 weeks. So with this bar's week here, when it broke below there, there's your weekly reversal. We were well aware that I took that short when it came back in this way. So I was short BTC. I took my profits already. I'm still short a bunch of other shit coins, for the lack of a better word. On the 2-day chart, very simple setup right there, because we know the weekly level. That's your weekly level right there, 96.5013 right there. It goes outside, inside, and up. Fails to break and stay above the weekly open. That's your purple line. And then when it comes back to the range, right, comes back out through here, because we know if this thing reverses, you're gonna break below the prior week's low with this time frame alignment here, below the weekly, and so that creates that nice little trade there. That breaks to the downside. So expecting Bitcoin now. We have a new month coming up tomorrow, the 1st of March. That's going to be a Sunday, and we have, of course, the new week, new month. So now we want to be seeing the next couple of days, next day or so, how price reacts to those new opening levels. Because right now you have a bit of mixed time frame, which is causing things to be a little tricky with Bitcoin. You got your quarterly open down here, your monthly open here. Now you want to see, where is this new month and week, where does it open, and how does price transact around that. Okay, but on the daily chart, that's what you're looking at here now. You got that 200-day actually making a little surprise appearance there, right there, right, and they're defending it right now. So right now the 200 days holding, but my bias is to the short side. I'm not expressing that with the Bitcoin, with the Bitcoin coin, but I'm short other altcoins. Perhaps a test of the quarterly open could be something worth looking at. All right, so just to fast fire a few final things, and we'll wrap things up. A very long video today, and I apologize, but lots of stuff to cover after such a historical week, and so I hope you forgive my length in this video. But I want to spend just a bit of time looking at the bigger picture of the sectors. Let's look at the quick of our review of our sectors here now to see where things are going, because the last week has changed the charts substantially on the sectors. Okay, so let's do this. Let's look at the monthly chart. So basic materials, Okay, already been in a tough situation. We're just going to go through the 9 sectors here. XLB, outside bar down now going into end of February. This is the thing, right? That's what we wanted to see. What was the next bar? It was down and it kept going. So it's not coming back through. And there's your broad information. I could probably draw that a little better. There we go. That was just the charting software that did that. Coming back through the range now. Watch out here. If the support doesn't hold, you're going back for December 18th, 2018's lows. Because that's an outside bar, right? Tests anyone who bought that breakout and thought they made a bunch of money. Coming right back through in the span of 2 months. Energy, wow, energy getting beat up. Now look at the broad information that we drew months ago, right? To the tick, right down there, right? So this thing has come back through the range, all right? Question here now, once again, deep in the Bollinger Bands, do we do the Bollinger Band walk and then keep going? It could keep going. You get down to, 40 easily, right? So the 40 area is definitely feasible. Financials, because don't forget here, let's look really quickly. It's outside bar down, right? So even though there's been some really big rips to the upside with energy, you have not taken out a prior month's high, right? This has now been 2 months, so you cannot expect to have a reversal on XLE until a prior month's high gets taken out. So that's a 15% down move for XLE there. So you need to come all the way down from here to take out that pivot high to extinguish this monthly momentum. Okay. So financials, how are they doing? Ouch, outside bar to the downside. You're going to see a lot of these outside bar types of scenarios, right? So you're still trading at pretty high levels here, but you do have this breakout being tested. So this point here, they had folks here who bought this, who bought this dip. Now it's come back out here. Now watch out for that low there, March 2019. Industrials, okay? This is not necessarily a good environment for industrial names. So I'll clean this up a bit on the 3-month chart. That's why I'm calling it a breakout. This was a breakout, right? So this 3-month bar, when I went inside bar up, it worked for 1, 2, 3 quarters. It was working this quarter as well, right? Into all-time highs until it does that. And then tests the buy entry of anyone who bought in Q1 of 2019, right? So that's a trade if you're in for a good year to all of a sudden come against you there. Now you're underwater after a year. Tech still hanging in there well. So look, right? Here's your outside inside. We pointed out this, close to a year ago. Outside inside break the upside. It was still working. Still working because it hasn't taken out a prior low yet, but has definitely given back a lot of those gains. In February, we now got an outside bar. So this momentum we talked about in the Qs, extinguished. What's the next bar? Staples. Are people running the staples? Not really. They're selling everything right now, right? So here, outside bar on staples. Look at that. Looked like it had been a safe haven, but look at our broad information, right? Caught that nice uptick there. And again, I drew this a long time ago. I didn't just draw this week. The reason why you can see I didn't just draw it this week is because it's anchored to previous pivots and they're not exact. Okay, that means I have not been moving this line around to try to fit it to these previous peaks. So it's just a generally drawn line, comes back in this area here, Bollinger Band high, back through the range, ticks out. There you go, that outside bar right there. It's liquidity right there. They take them out. Utilities, are they going utilities? Not even, right? So even that chase for yield for utilities and dividend paying stocks did not pay off this month because, man, it gave back all those gains, and they had a huge month back in January. Utilities were on fire. Unfortunately, outside bar stopping anyone who got involved, in this sequence. So when as low as, took all that and that as well. Inside bar down, inside bar reversal to the upside. It looked like a great trade. Came right back through again. Stopped folks out on that monthly chart. Watch out now. Does this offer support here on this broad information high? Right? Or it's going to pop up a bit, or you come back through the range because there's a lot of outside bars that if it gets back in here, you can expect to come out the other side. 2 more. Healthcare. Healthcare actually hanging in there a little better. Not an outside bar here, but did come back in. But healthcare out of the bunch, probably the best, and probably because it's being supported by a lot of names that do the coronavirus. It's probably not a bad place to be, relatively speaking. So there we are, drawing that broad information there. Okay, and the only issue here now is that you got to watch out for this low, October's lows, like we said for the indices. And finally, discretionary. Outside bar, all this small chop here now, it's been taken out, and we got to see how far this thing goes because that's an outside bar. So what's the next bar? Okay, so that's a broad overview of the sectors. This week I'm going to actually skip doing some of the underlying stocks because at this point there's so much stuff trading in correlations that you don't necessarily have to pick the best, like the absolute best setup. There's going to be a lot of stuff that's going to work. The more important part is, number one, make sure that if you're trading actively, that you're trading with respect to the volatility of the markets. Number two, this means getting your position sizing under control so that you don't have large P&L swings that can affect your trading capital and your mental capital. So with that being said, let's wrap it up for today. I want to thank you for listening to this longer video. As always, if you have any questions, feel free to post them in the comment section on YouTube or on our blog site, thetradingedge.org. If you like these videos, you can subscribe to them by subscribing through YouTube or subscribing to our mailing list on our blog. That way you get a notification as soon as the video gets released. And I send out a weekly newsletter as well with some of my thoughts on markets and trading perspectives and things like that each week. Sign up for that if that's of interest to you. And finally, just want to wish everyone happy trading and to be safe out there. These are volatile environments, and the name of the game is longevity. Yes, there are some really, really good opportunities right now in the markets, but if you're not comfortable with this trading environment, and if you're not used to and acclimated to this trading environment, then you don't necessarily need to push the pedal to the metal, so to speak, to try to make your year in an environment that you're not very, very comfortable in. So be respectful of your limits, of the markets, and once again, happy trading and have a great week. See you next week.